Marriott cut its full-year outlook for adjusted earnings after weaker demand weighed on profit in the hotel company's third quarter. The China market proving particularly challenged during the period. Revenue per available room in the region, that fell more than 8% from a year ago. Joining us now, we want to bring in David Katz. He's Jefferies Managing Director. David, it's great to have you here. So certainly we're looking at some disappointment play out in the street with shares under a bit of pressure here in early trading. I'm curious, how would you characterize, what was your biggest takeaway from some of that underperformance this quarter?
Yeah, look, I think what we're seeing from Marriott is consistent with like structured peers, right? We heard from, Hilton earlier in the quarter. And, I think you're seeing groups still perform very strongly, business transient remaining solid, but it's really the higher end leisure that has become a problem. Outbound travel versus inbound is still out of balance. Weather is still weighing on some travel and has impacted. And frankly, we're seeing, room rates and that consumer just start to push back on the level of cost for high end leisure travel. At the same time, we are seeing some of the lower end leisure, the driving customer. We've seen some of those companies who are focused their report, and that is sustaining itself quite well. So I think the structure of the miss is not terribly surprising. There were some other aspects that my sense is we're going to get to that were new information in the quarter this morning.
And real quick, before we do get to that, just in terms of some of that weakness that we are seeing, especially the higher end, is that a trend that you see even extending beyond this year and into 2025?
I do. When we look at, what's happened coming out of COVID in the past several years, the big picture, you've seen revenge travel trend for a while. You've seen a focus on, traveling to Sunbelt markets and high-end resort markets, and the room rates shooting up in those markets and really reaching well above pre-COVID levels. And that's consistent with the inflation you're seeing across the economy in a lot of different ways. But, I think we're seeing now customers start to push back on how much higher they are willing to pay. And that's, it's spread across different markets in different ways. Las Vegas, we cover closely, room rates have gotten very, very high. But I think as we get into 2025, it's going to be difficult to get any RevPAR or room rate growth. And let me just make one quick final point to that end. Internationally, there is still some room, particularly in Asia Pacific, non-China, there is still some room for RevPAR growth and rate growth. We're really talking about US and Canada where they've hit their head a bit.
And so since you bring up international and the room rates, and then additionally here, we have to think about the capacity that's eventually going to come online as well. Marriott Chairman David Marriott joined Executive Editor Brian Sozzi on an episode of Opening Bid last week, actually talking about Marriott's plans and opportunities overseas. I want to play this clip and get your reaction on the other side.
I just got back from a trip to India. We have 153 hotels in India and more than 85 in the development pipeline. So we're seeing tremendous growth in that country. There's places all over the globe where we have opportunity. We have 16% of the hotel supply in the United States and only 3% of the hotel supply outside of the United States. So we have tremendous opportunity for growth in developing countries and in nations around the globe.
And so with that thought in mind, where in the areas that you're seeing companies like Marriott and Marriott specifically in this case, investing in that capacity, are you expecting immediate or most prominent contributions to the business?
Mm-hmm. Yeah, I think Mr. Marriott makes a very interesting point, which is that in international markets, and particularly emerging markets, hotel supply still has plenty of room to grow. The branded hotel supply has a considerably higher rate of opportunity to grow than it does here in the US and Canada. And when we look at a company like Marriott, it's the largest in the world, their exposure in those markets still has plenty of room to grow. And when we look at the array of brands and the exposure that they have in the United States, it is harder to see a path of strong growth. Right. And so, they will be investing internationally. And the important point about investing internationally, particularly when it comes to management contracts, the structure of those contracts start to earn faster than the way management contracts are structured here in the US. So we look very carefully at management contracts when they are internationally. That profit-based fee, or IMFs, it starts to earn right away. And that's not the case in US markets. So a lot of room to grow and grow earnings for sure.